Happy Friday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. In an exclusive report published yesterday, the US-based Wall Street Journal writes that as US President Donald Trump and Russian leader Vladimir Putin signaled readiness for negotiations to end the war in Ukraine, China is actively positioning itself to play a role in the process. Chinese officials have informally proposed a summit between Trump and Putin, offering to facilitate post-war peacekeeping efforts, according to sources in Beijing and Washington. However, the proposal has been met with skepticism in the US and Europe due to Beijing's close ties with Moscow. Trump recently announced on Truth Social that he had a, quote, lengthy and highly productive, end quote, conversation with Putin, during which both leaders agreed to visit each other's countries and initiate peace talks. The first in-person meeting is likely to take place in Saudi Arabia. Notably, the proposed discussions exclude Ukrainian President Zelensky, raising concerns among Western allies about the integrity of Ukraine's sovereignty in any further agreements. The White House has rejected China's proposal outright, labeling it as, quote, not viable at all, end quote. Meanwhile, the Chinese embassy in Washington neither confirmed nor denied the offer, but reiterated its hope for de-escalation. Trump aims to resolve it within the first 100 days of his administration. China's involvement in the peace process is complicated by its economic and diplomatic support for Russia, which has helped Moscow resist international pressure for a ceasefire. Despite some internal debates within Beijing about the long-term cost of its alliance with Russia, China has strengthened economic ties with Moscow throughout the conflict. Leader Xi Jinping has met with Putin more than 40 times since assuming office in 2012, and their relationship remains pivotal to China's geopolitical strategy. European nations are wary of China's influence in negotiations too. While some leaders in Berlin and Paris acknowledge that Beijing could leverage its relationship with Moscow to broker peace, others fear that a US-Russia-China deal could sideline both European and Ukrainian interests. China's proposal to act as a guarantor by deploying peacekeeping forces has also raised alarms about potential geopolitical shifts in Eastern Europe. Vice President of the US J.D. Vance and Trump's special envoy for Russia and Ukraine, Lieutenant General Keith Kellogg, are traveling to Europe this week to discuss the conflict. Kellogg is expected to present Trump with multiple options to end the war, while Vance will outline the US stance at the Munich Security Conference. As the war continues with significant casualties on both sides, the Kremlin remains firm in its demands, including further territorial gains and a neutral, demilitarized Ukraine. Meanwhile, Ukraine remains steadfast in seeking military support from the West to counter Russian advances. China's diplomatic maneuvering comes at a time when Xi Jinping faces economic challenges at home. Some analysts believe Beijing sees an opportunity to negotiate with Trump in hopes of averting further economic sanctions and trade restrictions from the US. However, skepticism remains about whether China is genuinely committed to peace or simply aiming to secure its own strategic interests. As negotiations unfold, Ukraine's exclusion from the proposed talks remains a contentious issue, with European leaders insisting that any peace process must involve Kiev. Whether Trump's direct engagement with Putin and potential Chinese involvement will lead to a sustainable resolution remains uncertain too. But it is clear that global power dynamics are playing a crucial role in shaping the future of the conflict. Speaking on this development today, veteran China analyst Bill Bishop expressed, quote, "It does not sound like the proposal was well received, but I expect them to keep trying. The PRC probably wants to play the part of responsible peacekeeping global power while also ensuring a cut of the eventual massive reconstruction, even after all the military-industrial support they have given Russia to sustain its war on Ukraine." End quote. Next up, we move to the Chinese economy. With almost daily bad news about the economy, it is a nice change of pace to be able to cover some positive news. Though, as we will see, the context of this news blunts the positivity to some degree. After years of falling prices, China's stock market or at least some parts of it, may finally be seeing a period of bullishness. China's technology sector is experiencing a significant resurgence, fueled by artificial intelligence advancements and renewed investor confidence. The Hang Seng Tech Index has soared over 25% from its January 2025 low, surpassing gains in global markets, including the Nasdaq 100. This rally is largely attributed to DeepSeek's AI innovations, which have triggered a reassessment of Chinese tech global competitiveness. DeepSeek's unexpected success in developing a large language model with significantly lower computational requirements, it is claimed at least, than its Western counterparts, has reignited optimism about China's AI capabilities, at least with some investors. This development has encouraged foreign investors to revisit Chinese technology stocks, leading to a surge in market value for major players like Alibaba, Xiaomi, Baidu, and BYD. Alibaba, which has been struggling due to regulatory pressures and post-pandemic consumer slowdowns, has emerged as the biggest beneficiary of this AI-driven rally. The e-commerce giant's shares have climbed 46% since the 13th of January this year, adding $87 billion to its market capitalization. Reports of a collaboration with Apple and AI integration in China, which we covered earlier this week, further boosted Alibaba's stock by 9.2% in a single day. Investment firms now view Alibaba's AI initiatives, including its Qwen 2.5 Max model, as strong indicators of future profitability. The recent gains in Chinese technology stocks mark a stark contrast to the broader economic challenges facing China, including a sluggish real estate sector, deflationary risks, and trade tensions with the US and others. None of this will be unfamiliar to regular viewers. While the CSI 300 index has only risen 4% in the past month, the Hang Seng Index has jumped 15%. A sign of shifting investor sentiment towards technology-driven growth. We also note that these surges have come off a very low base after years of flagging prices. Chinese internet giants are now seen as the country's most globally competitive sector, with companies like JD.com and Meituan experiencing significant gains due to strong Lunar New Year sales and expectations of government stimulus. Meanwhile, data from the Stock Connect program shows a surge in mainland investors' interest in Hong Kong stocks, with February's average daily turnover up 66% from January and 3 times higher than the previous year. Another key factor in China's financial rebound is the revival of quantitative hedge funds. These funds, which had suffered heavy losses earlier due to regulatory scrutiny and market volatility, saw a strong recovery in late 2024. The government's economic stimulus measures, combined with increased market liquidity, have allowed quant funds to outperform stock benchmarks by nearly 10 percentage points. Definite Capital Management's CSI 500 Enhanced Index Fund, for instance, outperformed its benchmark by 50 percentage points in 2024. Other leading quant funds, such as Yanfu Investments and Shanghai Quant PI, have also seen impressive returns, attracting renewed investor interest. High-frequency trading strategies have particularly benefited from increased market turnover, though potential regulatory fee hikes remain a concern. Despite the optimism, challenges remain for China's AI sector and its broader technology industry, issues that we have explored in detail. The monetization of AI services is still uncertain, as domestic businesses and consumers have been slow to adopt paid AI products. Additionally, China's cloud business growth continues to lag behind US technology giants, with Alibaba and Baidu posting single-digit growth compared to double-digit gains by Amazon and Microsoft. Nevertheless, Alibaba's relatively low valuation compared to US technology giants, coupled with its expansion into overseas markets, presents an opportunity for sustained growth. If Chinese technology firms can capitalize on AI advancements and improve monetization strategies, they may continue to outperform global competitors in the coming years. Like I said, with so much bad news for the Chinese economy, it is nice to touch on something a little bit positive. But of course, with any sort of investment comes risk, and some market participants will be very slow to jump back into this market. Now, we have one more development to cover, but just quickly, if you're getting some value from today's episode of China Update, I have a huge favor to ask. That is just to hit that like button. And if you've not done so already, subscribing is also a tremendous help. Patreon and Buy Me a Coffee links are also in the description for those who want to go the extra mile and help me keep China Update financially sustainable. Thank you so much, everybody, for for the ongoing support. And finally for today, the nomination of Landon Haid an Assistant Secretary of Commerce for Export Administration signals a potential tightening of US semiconductor export controls, a move that is unlikely to sit well with the industry. Haid, a former staffer for the House Select Committee on China and a staunch advocate for limiting Beijing's access to advanced technology, will oversee the Bureau of Industry and Security, BIS, and its export control policies. Haid's appointment aligns with the Trump administration's broader efforts to curb China's technological advancements. The administration has been reviewing export control loopholes, and Vice President J.D. Vance's recent comments in Paris, which we covered earlier this week, further indicate an impending clampdown on semiconductor sales to China. The latest regulatory moves suggest a more stringent approach to AI chip exports and chip-making equipment restrictions. China has been the leading producer of wafer fabrication equipment, spending $41 billion in 2024 and accounting for 40% of global sales. However, research from Tech Insights projects a 6% decline in 2025, with China's share of global purchases expected to fall to 20%. Analysts attribute the slowdown to tighter export controls and concerns over overcapacity. The impact of these restrictions is already being felt. Taiwan Semiconductor Manufacturing Company, TSMC, the world's top contract chipmaker, has begun enforcing compliance with US regulators by refusing to ship advanced chips to Chinese clients unless they use approved packaging suppliers. This decision, originally believed to target AI applications, now affects all semiconductor production at the 16 nanometer level or better. With Haid at the helm of the BIS, industry insiders expect further restrictions on semiconductor exports to China, while some firms might seek exemptions or workarounds. The trajectory suggests growing challenges for Chinese technology firms reliant on US chip technology. The new measures could reshape the global semiconductor landscape, heightening tensions in the ongoing US-China technology war. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Friday, have a restful weekend, and I will either see you tomorrow or on Monday.